Thanks a lot. 4 years ago, I was filing my annual tax declaration. What billions of people do every year, whether they have crypto or not. And what happened? I spent way more time doing my crypto tax declaration than any other income, even though that was not my main source of income. So luckily, I was working previously as a content and finance, so I could build my own Excel file, Excel model. But this is not what everyone will do. Today, today we have tax software, and that's also why we built Waltio, which is, as you said, a crypto tax data platform that tracks transaction, helps individuals to calculate their taxes, and also make the proper tax report. So we launched 4 years ago. It helps more than 50,000 Europeans to build their to make their tax report correctly. So when we started to build Waltio, we realized that actually we learned a lot across the years on how the regime is and what we can improve on the regime. So today we have that sort of knowledge and expertise that help us to give you this feedback on 3 elements. One is whether what will be sort of learnings we can have from MiCA. The second element will be, and also DAC 8, so what will be the role of the EU can play. And second element is sharing with you how tax regulation can be smart and can help individuals to, not only individuals, but also to have a global adoption and safe adoptions of cryptocurrencies. And last but not least, I will share with you what we see as a good and the bad practices across Europe, but also outside, in the outside world, in terms of digital asset regulation. So, digging into what we see, if you look at regulation, we often say that regulation can prevent innovation, but that's not always the case, especially in digital asset. Today we are seeing, for example, in the US, where regulation is not stable, so some companies are considering leaving the country, where, as you can see in the slide with MiCA, it's becoming more attractive to specific countries. So having a dedicated, a specific tax framework will help corporate and individual to rely on and to be in a safe environment to invest in cryptocurrencies. So what we've seen with Europe was that actually MiCA has been providing a very harmonized definition of digital asset. What I talk about this definition is today, for example, here in Belgium, we don't have definition of what is digital asset, even though there is one in France, one in Italy, but these are not harmonized. And this is one thing that MiCA shared and give to us. It's harmonized and same definition of digital asset across country. And having that definition, it's the first step to have a dedicated and specific tax regime for digital asset. But if today MiCA has been helped for regulation, MiCA is not including digital asset. It's not including taxation for individual. It defines digital asset. It provides a framework for corporate, but this is not include taxation for individual. And so let's look at what's the role of the EU that has been playing in terms of taxation. And what has been interesting, looking at, for example, what's happened in VAT, Europe struggled to harmonize tax rate across Europe. And if today we see that Europe has some challenge or to provide a legal and stable framework across Europe regarding digital asset taxation for individual, or harmonize the tax rate, what we see is that the actually European Union has been very efficient on providing tools, reporting tools to tax authorities to track transaction, but also provide a framework that helps to control the taxation locally. And that has been done with DAC 8, which is directive on cooperation of the different administrations. So that provide, I said, that cooperation of tax authorities, transparency on in transactions that are be done by exchanges. Now, before digging into what we see as the best practices or good practices across Europe and the world, let's look at what we see as the worst or bad practices and elements that actually are not in favor of providing a global adoptions with a smartly and specific tax regime for the digital asset. First element is having no regime or unclear regulation. So, for example, what we've seen in the last months in Portugal, people thought that actually Portugal is no tax, so let's move there. But actually in Portugal, it's not that it clearly states there that there is no tax. It's just that at the moment there is no tax regime, no dedicated, no specific regime for cryptocurrencies. And what happened a couple of months ago? The finance minister asked to get a new regime on cryptocurrencies, and they were about to work on something that tax cryptocurrencies around 30%. So we understand that having a dedicated, specific regime for digital asset will provide that stability, will provide also the trust of the individuals to invest in cryptocurrencies or digital asset. Second, bad practices that we've seen is something that we see in France. In France, so at the beginning, we had a new tax regime launched in 2019, which at the time was very forward-looking, very innovating, very bold. But we see that this regime only addresses cryptocurrencies and also has a very complex formula, so it doesn't encourage individuals to track their portfolio on a yearly basis. And actually, when people want to calculate the tax as soon as they make a taxable event, they have to look back on the previous year what happened, which is obviously quite complex, not to say really headache. So that doesn't encourage individuals to track their portfolio very frequently. And also there are a lot of elements that are uncertain in terms of taxing passive income or NFTs. A third worst practices or bad practice that we see outside Europe is that the new tax regime that India put in place, very interesting. They actually ask the exchange, so what we call centralized exchange, the CASP or the VASP, the virtual asset service provider, to track the transaction, to make the tax report for their users, and actually collect the tax gain, which for us, we realize doesn't make any sense given the specificities of digital asset. So if you dig into what are the specificities of digital assets, there are two types of transactions that we see happen in digital asset world, but doesn't happen in traditional finance. One is swapping one coin to another, like one crypto to another crypto. And secondly, is sending one crypto to another account. This type of transaction require to get the overall portfolio transaction to track all of this across exchange, whether they are centralized, decentralized, and wallet. So if you ask a centralized exchange to make a tax report, you will only get a portion of what is actually happening on your account. And there is, if you, for example, buy one crypto on one exchange and you send it to another one, you need to track what is called the cost basis, so the purchase price of that crypto, to get to know what's the actual price you sold if you, for example, sold it onto another platform. So requiring this, so then when the government in India, it's also, by the way, happening at the moment in Kenya, they are just working on this, They required a centralized exchange to track this and to make the tax report for the individual. They realized, like, in that case, we need to have not a tax on the gain, but a tax on the actual, on the transaction. So they make a cut on the transaction, so which is change completely the nature and the culture of the taxation. So we do see also so requiring centralized exchange to make tax report for the individual as a bad practices, or at least something that is not relevant. It doesn't encourage individual to invest in cryptocurrencies in a fair way. What we see as the best practices, one is a clear and specific regime. It has been discussed and voted end of last year, went live Jan 1st this year in Italy. They create a regime that's very clear on how it's taxed on crypto gain. Second element that is also very smart is that actually they also consider all new type of services and type of income of cryptocurrencies, such as DeFi, stacking, earn. They are all mentioned in the local tax law. And finally, not only they look at cryptocurrencies, they look all across all digital assets, whether these are NFT, real estate token. So then we got a very comprehensive, very clear framework on all on taxation of all type of digital asset, and that actually provide a framework for these individuals, for all the Italians that own crypto, and they know how it will be taxed. A second best practice that we see is having a tax loss harvesting. It's the case here actually in Belgium. Tax loss harvesting is if you, I mean, we all know that in crypto sometimes you can lose a lot. That's the market, and there are, you know, few years where it's growing like crazy, and few years where it's sort of correcting. And if you make a net loss over a year, for example, you have to be able to report that years or to deduct it from the gain you will have in the upcoming years. Upcoming years. So being able to harvest a loss, we do see it as a best practice in order to incentivize individual to track the portfolio and comply with the local tax rule. Thirdly, what we see as a best practice is also offering, the flag is actually wanting to mention Germany, but another country. Also we see from close from here in Luxembourg, is providing a tax cut under a certain threshold. So meaning if you own cryptocurrency for more than specific period of time, could be 6 months, a year or more, then you have either tax deduction or no tax on the digital asset. And this actually also incentivize individuals to comply with local rule and also to, let's say, to invest in crypto. So now, we discussed first what kind of role Europe will play in terms of adoptions of digital currency, and so we understood that actually Europe will not work on the specific tax regime or harmonizing tax rate, but rather providing the right tools and the right reporting framework for tax authorities. We also understand what are the good and the best practices in terms of tax we see across Europe, but also outside it. Now what we see is that if we want to have global adoptions of digital asset and having that curve of adoptions that keep following the one of the internet, we will need to have a dedicated and specific tax framework for every single country. And that's the way we will have cryptocurrency adoptions. We see more and more countries embracing this, so we strongly believe that we have to act now in order to make sure that countries stay relevant. Thank you. Do we still have time left? So if we have 1 minute, let's take one question if there is one or two. Yeah.
Regarding
Yeah. So before thinking on well how works the under a certain threshold, you need to think about what's if you are making or not a taxable event. So if crypto to crypto is a taxable event, then it should work. But if it's not, then you only have to consider what kind of action you do, what kind of transaction you are doing, whether this is taxable event or not. If it is, obviously, then you can deduct it. Okay, I think we can take for a last question if there is one. Sure. Okay. Thank you very much. If no, thanks a lot.